A friend of mine asked me an interesting question about bank management fees. She told me her bank was charging her a flat fee of less than $10 a month, and that they were giving her all kinds of nice choices for mutual funds in her investments for our TFSA and RSP. So she asked me, if the bank spends the same amount of time with all their clients, how are they able to properly manage my funds if they're only charging me $10? She obviously never looked at her mutual funds fact sheets, because she would have seen the management expense ratios, the MER, which range between 2 and 3.5%. That's a lot. Once I pointed this out to her, we had a whole conversation about management fees. My name is Langevin from Claret Asset Management, and today I will explain in just a few minutes the different types of management fees and other fees that may be charged on your investments. Let's dive in right away into the subject and look at what is arguably the most common: mutual funds sold through your bank and other dealers. When you pick a mutual fund you want to invest in, you typically look at the fund's fact sheet. This is a short document, 1 to 3 pages, that tells you the strategy and return of this mutual fund. But it also tells you the management fee and the management expense ratio, the MER I mentioned, and all the other fees that may apply. Management fees are fees charged by the fund's investment manager, and the MER includes the management fees and other operating costs. MER is usually in the 2–2.5% range, but it can also be as high at 3–3.5%. Let's be honest, giving up 3% of your return is quite high, so a high MER reduces the return that you would have earned. If you go one step further and decide to do it yourself through the discount brokers of the banks, you will now be charged every time you make a transaction on the market. Typically, it's between $5 to $10 per transaction. So when you buy shares in a company, you pay a minimum of $5 per order. And when you sell that position, you pay another $5. Since you are now trying to survive on your own in the complexity of the stock market, you might also need to buy access to more information to make better investment decisions. This is another source of revenue for the discount brokers because you will have to pay for this as well. And it can cost a few $100s per month if you become over-exuberant and you take everything they have to offer. If you purchase exchange-traded funds, or ETFs, in your discount broker accounts, you will have similar but lower costs as those associated with the mutual funds on top of your commission. After that, you have the typical full-service stockbroker. These advisors, who take care of your investments, usually get paid through commissions, just like a real estate broker. That means every time you make a transaction. Those commissions typically range between 1 to 3% per transaction, but can also be lower. And that structure is why they might call you to do trades more often than you should. Their pay is an incentive to trade. You might also have heard about the hedge funds and the stereotypical 2 and 20 fees. The 2 means 2% is charged in annual management fees. The 20% is a performance fee, so they will take 20% of the return above a certain benchmark. I will not go into more details because it actually varies a lot, but you get the general idea. At Claret, we are portfolio managers who believe in full transparency, which is why we opted for the last option. Annual management fees charged quarterly in arrears. It might sound very complex, but it's simpler than it seems. Let's look at someone with $100,000 who pays 1.25% in management fees. Here, we have a typical calendar year. As I mentioned, someone with $100,000 would pay 1.25%. That fee is broken down and charged every quarter. So if you started the first quarter with $100,000 and made 2% in that quarter, you finished with $102,000. Since your fees are 1.25% for a whole year, you are only charged a quarter of that quarterly, or 0.3125%. You would think that the 0.3125% applies at the end of the quarter, but it does not. To be fair to our clients, we charge in arrears, which means we charge at the end of the quarter based on the initial value of the quarter. In this case, on the initial $100,000. So, on the first day of the second quarter, you will simply start with a little less than $102,000 because we took our fees. This way, our clients receive our services before we get paid. We also have internal pool funds available to our clients. Our funds allow you to achieve diversification in a cost-efficient way. Unlike mutual funds and other pool funds, we do not charge any additional management fees. And we also absorb all the administrative costs. So the MER of our pool funds is effectively zero. In other words, you have the benefits of owning a fund without the high costs. I hope this helps you understand your options. Please do not hesitate to reach out if you want a second look at what you are currently paying. Thanks for watching. For more investing tips, visit our website at claret.ca, and don't forget to hit the subscribe button.